Brilliant. Okay. So I think we'll get started, as mentioned. So thank you everyone for joining, and welcome to our Carrington Market Insight, the first one of 2023. I thought I'd just give you a quick summary of what we're going to talk about today. So we're going to have a quick recap of 2022 generally, and also the last quarter of the year. Some of our key thoughts on that year, and of course, including inflation, central banks, ongoing recession risks into 2023, and also China. And we'll also talk about our strategy moving forward and some of the actions we're taking within portfolios. As always, feel free to ask any questions you may have on any of the topics mentioned or any other questions you have. What we'll do is we'll look to answer all the questions at the end of the webinar. And there is a Q&A function, I believe, at the top or bottom of your screen, which you can click into and ask any questions there. So with that, I'll pass it over to Mo and take it away.
Good afternoon, everyone. Thank you very much for joining us today. So if we could just go straight into the presentation and start with this particular chart. So you may recall, if you joined us last quarter, that we had this particular chart on the screens. And what it essentially shows you is the MSCI World, which is basically the global equity market, and the Bloomberg Global Aggregate, which is the global bond market. And those are the two main components of any portfolio. And as you can see, from the September low, they did stage somewhat of a rally, but still ended down almost at the same point, down 16% in both cases. So clearly an exceptionally difficult time for portfolios investing in these two particular broad asset classes. If we move on to slightly more detail, so I've included another bit of data here, which breaks down a little bit of that. And I appreciate some of this won't mean anything to you, but just in summary, if you look on your sort of far left, you can see that oil had a very strong year due to the unfortunate events in Ukraine. And actually there were other factors, but that was sort of the key one. And therefore, as you can see, that really it was a very narrow market in terms of where you could have made some positive returns, and the vast majority of the other areas were down to varying degrees. You'll see here that about the seventh one along, the FTSE 100, so that actually ended up doing relatively well. So it was up about 4.5% by the end of 2022. The reason being is because it has a lot of exposure to the energy sector, so by Shell and BP. It also has exposure to the defense sector, which again was a beneficiary of the Ukraine war, and other areas such as tobacco and some of the UK banking sector happen to do quite well. So that put the FTSE aside as a slightly bright spot, which is, I suppose, unusual in the sort of past 10-year time frame. And then on the far right, you can see markets like the NASDAQ, the S&P 500, which are both US markets, and the gilt market. So the gilts clearly had a tough time, especially post the mini budget that we saw in September. Maybe one more point worth mentioning is right in the middle of the screen. There's something that says GBP USD. So that's just the exchange rate between the pound and the dollar. So what that's saying is that the pound fell against the dollar over the course of the year. So therefore, your assets that you hold in dollars appreciated in value. So, you know, in short, if you had lots of energy exposure and you had lots of dollar exposure, you would have come out in relatively okay shape versus pretty much any other part of the market. If we perhaps just quickly revisit the factors, obviously I've talked about these many times over the last year through the webinars and emails that we send out. But in summary, we of course saw double-digit inflation, the highest we've seen since the 1980s. That led to the fastest increase in interest rates in US history. You know, I quite often reference the US and their monetary policy, and that's because ultimately they are the area that dominate global markets and certainly impact us the most. And therefore, it's much more important to monitor what goes on in the US versus the UK, for example. We did, as mentioned, unfortunately see the war in Ukraine develop, which further exacerbated the inflation issue due to a large rise in energy and food prices. We had really ongoing from 2021 concerns around Chinese growth and the sort of global implications of that, particularly because of their connections in terms of the manufacturing supply globally. And then on top of that, they had their zero COVID policy. So I'm sure many of you have heard of that. And it was a very restrictive policy in place around any COVID outbreaks across China. So once again, further impacting Chinese growth and global supply chains. We also saw plenty of US-China tensions, which has obviously been a factor since Trump came into office, and Biden has obviously continued that. The rhetoric has certainly increased, and I feel that China or Chinese-orientated assets have perhaps been impacted more so than US assets, and that continues to be an area of tension. And then last but not least, as mentioned on the previous slide, that the UK gilt market had a meltdown back in September when the mini budget was announced. They have staged a recovery of some sort, but not quite to the levels they were pre the budget. We then move on to Q4 specifically. It was a better quarter for markets, followed by the difficult Q3 that we saw. And there was a rally across the board, really. So if we take equities, for example, they were positive over October, November, giving a little bit back over December. Bonds also had a good quarter, really, in November, and then going into December, the corporate bond market managed to hold on to those gains, with the government bond markets giving back those gains, so ending up flat over the quarter. But in aggregate, they were positive as well. Gold had a very good quarter as well. I believe it was up about 7%. And something else we noticed was that the dollar weakened over the quarter as well. So that would have, as it helped us last year with our overseas holdings over the course of 2022, the final quarter actually worked against us. So the dollar weakening was a headwind for our overseas assets. And I think I've got the chart. Yeah, so we've got a chart here which brings that last point to life. So this is the main US stock market, the S&P 500. The blue line represents a holding in pound sterling. So if you hold the S&P 500 in pound sterling, your return over the last quarter would have been slightly negative, and that was because of the dollar weakness working against you. The red line is exactly the same index, but in this instance, the currency element of it has been removed, so hedged effectively. So what the experience you get is of the actual US stock market performance, and you're not sort of impacted by the currency element of it. So you can see there was almost a 7% difference between the two. And the reason why I mentioned these two specifically is because in many of our portfolios, we do actually own both. So we used to have just the ETF that's in blue, but towards the sort of latter half of last year, we decided to remove some of the exposure to the blue and add more to the red. So clearly that helped us in Q4 and has helped us to a degree this year as well. Really, I mean, as was the sort of the case over 2022, the markets continue to be dominated by macroeconomic themes. However, they have slightly changed since the last quarter. And hopefully some of you saw in our commentary we put out in October, we did highlight some potential positives that were on the horizon that could create a change in sentiment in the markets, a slightly more positive one. And several of those did actually come to fruition to varying degrees. So we did, on the inflation front, we were seeing, and this is specifically, by the way, US inflation, we were seeing headline inflation data starting to come down at the last quarterly webinar we did. That has continued, and I will touch on that in a bit more detail on the next slide. As a result of that, the markets have now changed their thoughts about interest rates in the US and actually, to be fair, the UK and Europe, in that they expect the interest rates to be curtailed somewhat, so that the increases to be curtailed, and we may well see a pause in that picture over the near term. Due to the economic data that we've seen, which has actually been slightly better than expected, more so on the employment front than elsewhere, such as the property area, there was a lot of talk about a hard landing or a hard recession a quarter ago. That has now changed to more of a softer outlook, and that's more the sort of market expectation. We of course don't know the actual outcome yet, but the sort of narrative and the consensus has certainly changed around that. And then of course changing China's COVID policy. So again, we were expecting this to happen, but probably not as quickly as it happened. And it was an unexpected reason, which is public discontent around the policy and how restrictive it was. And we did see some very rare anti-government protests in China. So that and I think it's fair to say concerns from the government around economic growth, which had been weak for quite some time now. So that led to quite a rapid change in policy, i.e. they've now eased significantly. And that led to quite a material rise in some of the Asian markets through Q4 and into this year. So in aggregate, there's a slightly better sentiment, I would say, at the moment in the markets. And just with regards to sort of performance stats across the portfolios, depending on which one you're invested in, they were up between sort of 1.7 and 4.3% over the quarter. And clearly the higher risk, higher equity content portfolios were the ones that performed better. We now move on to a little more detail on those final few points I just mentioned. So with regards to inflation, what we saw last time and what's slightly different this time is that both the headline and the core inflation data are now showing signs of slowing. So previously it was just the headline number, but the actual core element, which is when you strip out energy and food, the more sort of volatile elements of inflation, that was not really showing any signs of rolling over. However, that has now changed. We have seen both decline, and in the US, the headline rate is now at 6.5%, so quite a material fall from almost 10% where it was only sort of 5 months ago. As we know, energy prices have been falling. The oil prices come down a fair bit. The gas prices have certainly come down quite materially, and some of the supply chain issues have been easing as well. With regards to central banks, then and interest rates, the US Federal Reserve, a lot of the commentary has come out and suggested that a slower pace of hikes will now follow, and a pause is on the horizon at some point this year. It's anyone's guess as to where the pause will come, but roughly speaking, it will be around about 5% is sort of the broad expectation. And that does move around a lot. And the Bank of England and others, such as the European Central Bank, are on similar paths. As I mentioned, a lot of the recession concerns have changed to more of a sort of mild outlook based on the economic data that we've seen so far. And as I've already mentioned, China's eased a lot of their restrictions, and that will continue through this year and beyond. So just in summary, and the market effects, we did see a general rise in markets and improvement in sentiment. There's been an increasing focus on quality businesses. So clearly the environment has been exceptionally difficult for those whose balance sheets are not particularly strong, or those that are carrying lots of debt. Debt servicing and debt refinancing has become significantly more expensive. So there's definitely been a bit of a shift in focus. And the other area that we'll come on to a bit later are government bonds specifically. So they had a very, very tough time last year due to the rising inflation and interest rate backdrop. But since some of that is now reversing to a degree, government bonds have suddenly started to come back and recover. So in terms of our strategy moving forwards, based on all of my sort of commentary the last couple of quarters, the focus has been to try and lower volatility in the portfolios, but to remain invested, because ultimately we don't know when a large sort of catalyst will come through that will be positive for markets, and quite often, the markets react very, very quickly, and we won't be able to respond to that. So we try to remain invested as much as possible. However, we're going to maintain a lower volatility approach because we think that the conditions will remain restrictive. So as an example, in the US, despite the fact that inflation is coming down and etc., interest rates are going to keep going up. As I mentioned, they're currently around about 4%. The expectation is for them to go up to 5%, and the US Federal Reserve have made it very clear that they intend to keep them there for until at least next year. So that will create relatively tight conditions for businesses, and we therefore feel that there are probably we're probably going to still see a degree of volatility over the course of this year, and therefore we should not be trying to take excess risk anywhere for now. I mentioned the government bonds, and typically what happens in these sorts of environments where there are concerns around recession risks, future expectations of growth begin to decline, and that in turn, as well as easing inflationary data, should lead to a fall in bond yields, i.e. a rise in bond prices. And the most potent way to do that are via government bonds. And I'll come on to actually what we're doing there for the portfolios, by the way, that we can actually build exposure in, because it's certainly those that have more exposure to non-equity related investments. Clearly, the portfolios with very high equity levels, what we could do is quite limited. On the equity front, we're going to maintain our largest exposure to the US markets, but however, maintain a healthy allocation to non-US markets such as the UK and certainly Asia. We're going to maintain large cap over small cap, so just focusing on large international businesses, many of whom have seen these sorts of environments many times before, have dealt with them many times before, and therefore should be able to navigate through the current environment better than most. And so, and again, focusing on quality, so just ensuring that the businesses that we have in place, as much as we can, are of a better quality. And again, those that are can navigate these environments better than those who are likely to run into trouble. And the focus there is also on a minimal style bias. So what I mean by that is not having too much exposure to companies that are of a high growth nature, so technology, for example, and conversely, those that are much more cyclical or economically sensitive, such as materials or energy businesses. We'll have a bit of those on each side, but the focus has really been on the core, the middle, and making sure we have lots of that exposure and maybe a little bit of both growth and value or cyclical businesses on either side, but to try and keep a balance between them so that we don't have any particular tilt or biases in any way. Something, so as I mentioned, we think that conditions will remain restrictive, and therefore there is a chance that volatility levels could rise again at some point this year. We have, for our active portfolios, thought about some volatility protection via one or two particular funds. And if I talk about some of the actions we're doing, so we've actually brought in a fund already in Q4, where possible in our non-equity exposures that can profit from a large rise in volatility. And there are one or two others that can also do that are already in the portfolios. In terms of large caps versus small caps, so the only real exposures we had left to smaller companies were in the UK, and you may have seen some of the commentary going out around that. But some of those funds we've owned since 2016. They've been very strong performers for us, but I think that given the sort of difficult conditions at the moment, and we felt that we could continue to see tricky conditions for certainly smaller companies, we felt that not having exposure now and focusing again on the larger businesses that were much more liquid and were probably better positioned to navigate this environment were sort of a better place to be. So we've again in Q4 we've sold the remainder of our small cap exposure. There wasn't very much left, but we did so and just simply went up the cap scale into some of our existing UK holdings. With regards to the regional exposures, we've had an overweight to the Asian region for a while now. We've been very active across the portfolios in mainly our developed market parts of the models. However, we've taken a longer term view with some parts of the portfolios, and particularly that relates to sort of the Asian emerging market part, where we think the long-term growth prospects are very favorable. And so we've maintained an overweight to that particular region. And clearly this year that's helped us because the strongest performers so far this year have been some of our Asian equity funds. Actually, just one more point with regards to the non-equity part and the models that are much more exposed to bonds, for example. We began to, you may recall that we began to introduce more bond exposure back in sort of June, July time, very, very steadily, of course. And we continued to do that throughout the remainder of 2022. And we introduced some government bond exposure through into Q4, and in the latter half, back in December, we added a little bit more, just based on the thoughts that I mentioned earlier around what potentially could do quite well in the current environment. So we expect to perhaps increase that more so in the next couple of months as the year progresses. So in summary, we think in the very short term, the sentiment has improved and the markets are likely to be supported by the easing inflationary pressures and easing Chinese policy around COVID. However, monetary policy will remain restrictive, and that could potentially lead to some volatility later in the year. So we want to make sure the portfolios are relatively insulated, just in case. Of course, the markets are focusing more so on the unfolding data that we're seeing. And as I mentioned, because some of the data, particularly around employment, has been relatively okay, some of the concerns around the unfolding recession have eased. We, of course, don't know the actual outcome yet, though, and so are also monitoring very, very closely. As per last year, we think that flexibility and nimbleness will continue to remain key as we progress through 2023. That brings me to the end, I believe, of the presentation, and I'm very happy to answer any questions that you may have.
Brilliant. Yeah, well, thank you, Mo. Thank you for that sort of summary as well. It was a tough 2022, so it's nice to see that markets have started somewhat positively into this year. We've had a couple of questions on a couple of topics, so I thought I'd start with perhaps the final point you made in the summary was around recession. And I think it's a consensus view now that the developed markets are going to experience a recession. But you spoke about how markets are now pricing in a softer recession as opposed to what was previously called a hard recession. Is there a risk that markets get that wrong, and like they did with inflation, because initially markets and central banks were saying that inflation was transitory, and then it turned out to be quite the opposite. So is there a risk that markets do misprice a recession?
I think with all things, the markets are at risk of being wrong. And as you say, they did not do a good job with regards to the whole inflation picture and the subsequent reaction of central banks and raising interest rates, which is why we saw so much volatility, because the markets had to sort of readjust and reprice based on the new environment. So yeah, I think that, as with all things, it's very, very difficult to give a firm answer, and the markets don't always get it right. And so that's why we've ensured that we've focusing on sort of large international businesses that are very high quality. We're bringing in some more government bonds where we can to try and help defend against that. We've got some volatility strategies in place as well, and they're all sort of more just in case the markets are wrong.
Sure. Okay. Yeah. I mean, and you spoke about some of the changes you've made, for example, reducing your UK small cap exposure and increasing it to large caps, and remaining relatively overweight to the Asia regions. And as you touched on in the presentation, China has since scrapped its zero COVID policy, and markets in China have seen quite a big bounce from that. Do you anticipate that will continue, and would you allocate to a China-specific fund? You've spoken previously about the Asian and emerging markets funds, and if China has a positive outlook, maybe you could allocate to a China-specific fund there.
Yeah, look, I think we're probably still early days in terms of the recovery in the Asian and Chinese markets, because this news has just broke. So, the consumer is still generally finding their feet and getting back to the shops, etc., traveling again, so this is a sort of developing story, and I think it will continue to head in a positive direction with regards to the easing of COVID. With regards to the growth outlook in China, that's clearly more difficult to comment on, because we don't really, well, firstly, not sure how accurate the data is that comes out of China. Secondly, they've had a lot of challenges around growth, not just due to COVID, but other reasons as well. And so I think it could be a tricky area to invest directly, given that we don't really know which way the growth trajectory is going. But certainly from a consumer perspective, we expect that a lot of those areas of the markets could continue to recover and do well. So yeah, probably steer clear of China only at the moment. Very happy to have some exposure via our funds that we have, and they all have sort of varying degrees of Chinese exposure.
Mm-hmm. Sure. Okay. Thank you for that. And again, I guess another question on regional specifics is the UK. What are your thoughts on the UK moving into 2023? As you mentioned at the start, FTSE 100 has had a positive year relative to other markets. So it'd be interesting to hear your thoughts coming into this year.
Yeah, it's probably quite unusual, isn't it, really, that we're talking about the FTSE 100 being one of the best performing markets of 2022. Quite often it's the US markets that tend to be the stronger performers. And the factors that led to that, I wouldn't say are a one-off. I mean, clearly, the invasion in Ukraine gave a lot of support to the companies in the FTSE 100. Given that we are now entering what could be a more tricky period for economic growth globally, certainly in the developed markets, I suspect some of those businesses will come under a bit of pressure short term, because they are more sort of cyclical in nature. They're more sort of economically sensitive. So, when economically speaking, things are a bit more difficult, then those businesses can struggle. And so I think we'll probably see the FTSE 100 give some of those gains back at some point later this year. And maybe worth mentioning that a lot of our UK exposure, as I mentioned, are large international businesses, so they don't really have much to do with the UK itself. The actual domestic exposure is fairly limited, and so therefore I think I'm very happy to maintain our UK exposure the way it is. Focusing on those international businesses again, I think is the right thing to do. We actually, by the way, you may have noticed we have introduced a holding that is replicating the FTSE All Share performance. So it has a degree of the FTSE 100, and we're blending that with some of our strategies and our core models on the active side. So I think the sort of blend between the two and that focus on large caps should stand us good stead moving forward.
Mm-hmm. Brilliant. Okay. And one final question, you briefly mentioned it during the presentation, was on gold. Obviously it had quite a strong Q4 and started the year quite well. Could you just briefly explain or understand why it's performed well, and again, and any thoughts you have on it specifically coming into this year?
Yeah, sure. So I appreciate gold can be quite a confusing asset, because often people say that gold is an inflation hedge, and we saw plenty of inflation last year, and yet gold didn't do very well. It's the actual sort of performance of gold is more tied to the performance of the US dollar and real interest rates. And so what we saw in Q4, as I mentioned earlier, was that the dollar weakened somewhat. And as a result, gold had a pretty strong course, and we've kind of seen a bit of that this year as well. The dollar hasn't really gone anywhere, and gold has continued to move higher. And so, on a sort of, it's obviously don't want to make long-term predictions, but the expectation is for after such a long run of strong dollar performance, at some stage, as with all things, that will have to give back at some point in the near term. And so we expect the dollar at some stage to give some of those gains back, and therefore are relatively positive on the outlook for gold. There are other reasons as well, which I can go into more detail, but I would save that for anyone who's very interested, and please follow up separately on that point.
Sure. And just a reminder, do we have exposure to gold across all the core models?
Yeah, most portfolios have so certainly the core portfolios, which is cautious balance of growth. The ETF portfolios as well have gold, and the sort of the sustainable growth doesn't, for obvious reasons, and one of our other high risk portfolios does not. But most portfolios do. Yeah.
Brilliant. Okay. Well, that's all the questions we've had so far. As Mo mentioned, if you have any other questions related to anything in the presentation or about anything else, you can always get in touch with either of us, and we'll be happy to answer those questions in more detail for you. But for that, I think I'll say, thank you, Mo, and thank you everyone for joining us. And yeah, I hope you have a good start to your year.
Thank you very much, everyone.
Cheers.
Take care.